Investing is the only arena in life where people run away when things get cheaper. Imagine walking into a store, 50% off everything, and you start sweating, shaking, panicking. That sounds insane. Yet this is exactly how most people behave in the markets. Ask yourself, are you a shopper or a speculator? There is a strange sickness in modern investing psychology. When prices are high, people feel safe. When prices crash, people feel terror. But crashes are simply discounts. Markets don't disappear, they reprice. The man who understands this becomes powerful. The man who fears it stays poor. If you've picked something with proof of concept, real demand, scalable market, durable fundamentals, then a crash should not shake you. It should excite you. Price goes down, value stays the same, opportunity increases. The crowd panics, but winners shop. Money does not reward intelligence alone. It rewards emotional discipline. Most people can analyze a stock, a business, or an asset. Few can control themselves when it bleeds red. The market tests your character more than your IQ. When everything is falling, your brain screams, sell now. You're going to lose everything. Everyone else is getting out. But the calm investor whispers, nothing about the business has changed. The product still works. People still need this. This is my chance. Your emotions either make you rich or rob you blind. Picture this clearly. You walk into your favorite store and every item is on sale. 30%, 40%, 60% off. Do you panic? Do you sprint for the exit? No. You pull out your wallet. So why do you panic when stocks, real estate, or assets go on sale? The only difference is, in the store, you trust your eyes. In the market, you trust your fear. If you wouldn't panic in a sale, don't panic in a crash. Same logic, different environment. You should only panic if you bought trash, you chased hype, you didn't understand what you owned, you speculated, not invested. But if you invested in something real, proven, and scalable, a crash is your ally. It transfers wealth from the emotional to the disciplined, from the impatient to the prepared, from the crowd to the few. Look at Warren Buffett during the 2008 financial crisis. Banks were collapsing, markets were in freefall, headlines screamed catastrophe. People were terrified. Most investors sold everything at the worst possible time. Buffett did the opposite. He injected billions into Goldman Sachs and Bank of America when panic was at its peak. Not because he was reckless, because he understood something deeper. The system wasn't ending, it was repricing. He wasn't betting on emotion, he was betting on institutions that would still exist after the storm. While others saw chaos, he saw discounted dominance. While others fled, he stepped forward. Years later, those investments became enormously profitable. The pattern is simple. Panic creates discounts. Calm creates wealth. Buffett didn't win because he was lucky. He won because he stayed rational while everyone else became irrational. This is how power moves in markets. So from this day forward, if the fundamentals are intact, treat every crash like a clearance sale. Ask, has the demand disappeared? Has the business model broken? Has the world stopped needing this? If the answer to those questions is no, you don't sell, you accumulate. Be the person buying while others are crying. Markets will crash, fear will rise, crowds will scream, and you will stay calm because you don't invest on emotion, you invest on truth. When everything is on sale, you don't panic, you shop. That is how you build real wealth. Do not be deceived, young king.